welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our October 4th of 2022 edition of Insights and Observations. Markets are moving, so let's get right to it, and thanks for watching. So what we're experiencing in the last 24, 48 hours is a risk on rally, if you will, in the middle of a bear market. So we've seen the equity market yesterday, we've seen the equity market today take off and absolutely scream. In fact, you put these 2 days together from a historical standpoint, we are in history in the making. That being said, the fixed income side has been ultimately what we see with bonds is the second worst fixed income or bond market since 1931. And that's simply because it's a story of interest rates. As interest rates rise, bond prices go down. And so we've seen a reverse of that in the last 48 hours. Now, Robert, why is that? Well, ultimately, let's go to the board here and I'll explain a little bit deeper as to what's happening behind the scenes. And it really comes down to, is bad economic data good? So is bad news good news? And the answer is yes. The markets are interpreting the bad information that we're getting as it relates to the U.S. economy. Remember how we talk about high frequency data? We spent a lot of time on this. We especially did this going back to March of 2020, all the way through the pandemic, because we were checking high frequency data. Were people moving around? Was the economy opening up? Was it reopening? That's how we knew that was ahead of forward indicator as to how we would allocate capital. Well, at the same time, we use the same high frequency data to see if the U.S. economy is slowing down by way of manufacturing, by way of jobs. Why is that important? Well, the Federal Reserve needs to slow down the economy because they want to bring down inflation. Inflation because of supply chain, because of all the obvious reasons. Obviously, energy and food and commodity prices have gone way through the roof. In fact, the kitchen table economics is what you and I spend money on. That's still high and hot by all estimations. In the meantime, there's two main factors, right? The inflationary pressures that are in the economy that the Federal Reserve is squarely going after, and also the job openings. Now let's go there. The JOLTS report came out today, and as soon as it did, markets rallied on this. And ultimately, the JOLTS report ultimately says is there's 2 jobs open or 2 job opportunities for every one employee in the U.S. right now. So a 2-to-1 ratio is probably why we're seeing a lot of that wage constraint, high inflationary pressures, right? So the U.S. economy needs workers. Now, there's one way of doing it is we can't just invent workers out of nowhere. The U.S. economy needs to shut down or slow down the openings. And that's what the Federal Reserve specifically said in their testimony. They're going to go after and basically slow down the economy so that corporations either freeze or lay off their current pace of employment. So we're already seeing it. Job openings went down month over month by $1.1 million, or a 10% decline. Well, that's welcome news for the economy simply because it shows that the Federal Reserve potentially what their policies are doing and how it's affecting the economy is slowing the economy. Therefore, that means inflation is subsiding, moderating. We shall see. So that means that they won't have to be as aggressive moving forward, meaning interest rates maybe could be peaking at the end of this year. We still fully anticipate the Federal Reserve to grow 75 basis points in the first week of November. That's their next meeting. But between now and then, they've got a lot of economic data. As an example, like the PMI, Purchasing Manager Index, and the IMS. This is my dyslexia here, right here for you. But those two from the manufacturing, again, it's a forward indicator on the economy. It's either expanding or contracting. Above 50, we're still expanding, but the rate of decline is now increasing. We had well over 52 last month. So now we're coming down by double-digit points here. So a negative print on the U.S. economy in the manufacturing and the Purchasing Manager Index is a positive, believe it or not. And then the also the IMS report is down 4.2%. Again, another welcome sign that the Federal Reserve's actions are actually affecting the economy. Now, we don't want the economy to slow too quickly or too much or too greatly. And that's really where it comes down to. We're seeing why is the market up? Because the U.S. dollar is coming down, because the yields are coming down. Okay, but the real question is, and the real forward-looking indicator that we're going to have real-time data for us to pay attention to is what the third quarter reporting season is now upon us. And we're going to see what all corporations are doing. Are they freezing their hiring? Are they laying off? Well, yeah, in the tech sector they are. If you read the Wall Street Journal like we do, every single day you're seeing that. And that's obviously being reported here in the JOLTS report as well. Now, what what do margins look like? Because top line earnings are still coming in even above expectations, double digit. In fact, last quarter, over 75% of the S&P have beaten the expectations, not just met, but beat the expectations. We could see earnings come in very favorable again because expectations have been lowered. I talked about this on CNBC last week. But at the same time, it's their forward guidance. So the current results are important, but what's most important are forward estimates at this point in time. What corporations see in the future, how they're going to handle a potential recession. Does it turn into a global recession? Is there contagion? And then what does it do in terms of pricing pressure, in terms of wages, or even supply chain inflational concerns as to their margin? Do we see margin compression? Now, the stock market, as we've known and seen the last year to date, has been discounting all of this. The U.S. stock market and all markets are forward discounting mechanisms, okay? So they are down by anywhere from 20 to 30% respectively, depending on what indices you're following year to date. Now, we've seen earnings come in, even positive, plus 3% right now. The forward guidance is going to tell the story. Do we see markets really go to lower lows after this bear market rally? Or is this a double bottom because markets have overdone it in terms of selling pressure, anticipating the worst is possibly to come? We don't know, and that's why we have to see how this plays out moving forward. We're positioned. We still like energy. We like healthcare. We also like dividend-paying companies for our clients, and we got a lot of cash on the sidelines, and we're putting that and asset allocating that appropriately, given either which way we see the market shake out. But in the meantime, we're seeing green on the screens. Markets are up. The dollar's down because the yields are down because of negative data that we're seeing. And so we're going to continue to watch. There's a lot more data to play out in the month of October. In fact, there's a lot more employment numbers that we're going to keep our eye on in the short term later this week. So that's our update for today. That's why markets are moving the direction that they're moving and sort of the science behind it. So right now, economic data that's negative is good news for markets because that means that the Federal Reserve doesn't have to be as hawkish or raise interest rates as aggressively moving forward. Let's see if this story continues. Thanks for watching. We'll see you next time.